Hi, everyone. Thanks for coming to our session tonight to go over employee compensation and then also the Savers and Child Tax Credit. These meetings are recorded, which I have just started. That is why you are all muted and why the cameras are turned off. If you have any questions, you can use the meeting chat function or you can raise your hand. I will stop at various points during the presentation to see if anyone has any questions. If it's a question that we're going to answer vocally, meaning you ask the question, I will need you to unmute yourself once I call on you. So hopefully you guys can see my screen. It says Chapter 4, Employee Compensation. Last week, I covered chapters 1 through 3, and that recording was sent to you by text on Monday. If you did not get that message, reach out to us at taxschool@mijhtaxpro.com, and I'd be happy to resend the link to you that way. But I'm going to go ahead and get started because it's late. It's been a long day, and I'm sure everyone here is ready to get some rest. Again, my name is Dawn Copenhaver. I am the Assistant General Manager for Moore Tax Service. And you guys have been working with Brian. He's our General Manager. And I'm sure many of you have spoken with Kathy, our owner. Both wonderful people. My primary role during tax season is to work with the new hires, make sure they get settled in correctly, work on additional training that they may need throughout the tax season. And then obviously I prepare a lot of tax returns on top of that. I have a lot of years of experience, many of them working for Jackson Hewitt. Ashley, I see your question. No, you can watch these right away. A lot of the slides are going to be exactly what you see on the online presentations. This just kind of gives you more of a real world view on things that we cover or we experience in the real world when we're doing tax returns for people. It's not going to hurt you at all to watch these presentations and then go do the module online. So it's just a little extra thing that we try to give you guys so that you can ask questions, etc. All right, let me switch my screens here so I can see my presentation. If I can figure out how to do that. Okay, so if you guys can't see the screen for some reason, please let me know. All right, so employee compensation. What am I doing wrong? The screen's not changing. Bear with me, I sometimes am technologically challenged. Okay, there we go. All right, employee compensation. So in this chapter, what we're going to cover is we're going to go over Form W-2. I know everyone who's ever had a job gets one of these every year, but there's usually a lot more to it than you ever really think about. We're going to talk about how to enter the W-2 into tax software, what kind of treatment certain types of pay have. So if you work for more than one employer during the tax year, you're going to get a W-2 from every employer. Employers are legally required to send out their W-2s no later than January the 31st of the tax year. And there is a workaround for people who never get their W-2. After February the 15th, we have an option. It's called Form 4852. It's basically a substitute W-2 form. It's a lot less accurate. So we always encourage people, reach out to their employer, reach out to their employer, reach out to their employer. So W-2s, when they're produced by the employer, there's 6 copies. Copy A gets sent to the Social Security Administration. That's how they keep track of your work credits. Copy 1 is sent to state, city, or local tax departments. So when an employer creates W-2s, if they have to collect state of Michigan taxes or Grand Rapids taxes, every taxing authority gets a copy of the W-2. And then copy D stays with the employer. Your customers or clients should never have copy A, copy 1, or copy D. Occasionally they will, if they work for a very, very small business that doesn't really know what they're doing. But I would say I've maybe seen that one time in 15 years. The copies the employee should receive, and now so many of them come digitally, they're all usually on one page, or they'll get a PDF that has multiple pages of the same thing. But they get a copy B, which when you file a paper return gets attached to the federal tax return. Copy C that they keep for themselves, and then copy 2 that comes that you would put with the state, city, or local tax returns. I would say now in practice, about 50% of the W-2s are coming in electronically, meaning the people download them from a website or they're emailed to them through their employee portals. So we have a lot of people who come in that we have to help them get their W-2s off of their employer websites or teach them how to send them to us so we can enter them in the tax software. All right, so IRS Form W-2 copy B. All W-2s have the same boxes on them, but they may not look like this example. Sometimes the information's laid out in a different format, but again, box 1 will always be wages. Box 2 will always be federal income tax withheld. So no matter what layout the W-2 has, it's always going to include the same information for each employer. If you do not have the employer identification number on the W-2, you cannot e-file. So it's important that if you get a W-2 in the office, that 1, you shouldn't, but 2, the employee needs to reach back out to their employer to get that information corrected. Items reported on the W-2. The most common item that's on Form W-2 is wages. That will be in box 1. Wages include any money paid to the employee. And when you have a W-2, box 1 always carries to line 1 on the 1040 form. Box 1 will include, like I said, wages, so your hourly wages or your salary total for the year. If you're a tipped employee, it will include any tips that you reported to your employer. If you're awarded any prizes, awards, or bonuses, those are also rolled into box 1. If your employer has a sick pay policy, that will be included in box 1 as well. Any non-cash payments, including certain fringe benefits, and then premiums for group term life insurance that's for salaries over $50,000, or if the policy covers more than $50,000. Boxes 3, 5, and 7 are related to Social Security wages, Medicare wages, and Social Security tips. And we'll go over Social Security tips here in just a moment. Boxes 2, 4, and 6 always show taxes. So box 2 is federal income tax. Box 4 is your Social Security taxes. And box 6 is Medicare taxes. What they also call, those are the credits that go into your Social Security bank. Okay, so box 4 Social Security tips should always equal 6.2% of Social Security wages. That is the employee's portion of Social Security tax. Your employer pays your other half of Social Security tax. And then Medicare taxes are always in box 6, and it's always 1.45% of the amount in box 5. Occasionally we'll see some variations, but it's usually a rounding thing or something weird. Now, there is a maximum amount of income that you have to pay Social Security wages on, and you will see some W-2s come in where box 3 amount does not match box 1 and 5. That's not unusual, so especially if they're a very high income earner. And then box 12 is another very important box on Form W-2. These set of boxes give us a lot of information as tax preparers. Code D is 401k contributions. 401k contributions, depending on the taxpayer's total income, can result in a saver's credit, and we're going to talk about that in a little bit. Code DD is informational. That code started when the Affordable Care Act came into play. Employers started having to report the total value of the health insurance plan that they offer their employees. Like I said, it's purely informational at this point. They really haven't done anything with it. It doesn't affect a person's tax return in any shape or form. So I'm sure the government is tallying this information and using it for something. I'm sure they don't just ask for information just to have it. Occasionally you will see a code A, that is Social Security tax the employer was unable to withhold for tips. Code B is Medicare tax that the employer was unable to withhold for tips. Honestly, I don't know that I've ever seen a code A or B. So just informational again. A code Q you'll see occasionally on military W-2s. It's for non-taxable combat pay. Let me see. I'm just scrolling through here to see if there's any other ones that are common. Okay, boxes 14 through 20 on a W-2 form. These usually are informational. So, well, box 14 is informational. What I used to see most commonly in box 14 was report of union dues back when that was a miscellaneous itemized deduction. Charitable contributions made through payroll deduction are often reported in box 14. Occasionally, some companies will report their health insurance, that they pay for the employees or what their deductions were in box 14. Again, most of these don't carry to any area on the tax return, but they're good to know what they are for in case you have a state that needs to do it, like SDI as short-term disability insurance. Box 15 is always going to be the state information. State ID number is very important. We have to have that to e-file a tax return. Some states don't even have income taxes. So if you get a W-2 and there's no state information on there, it could be that they lived in a state like Florida that does not have state income tax. And then boxes 18, 19, and 20. If you're working in Michigan, you may see these on quite a few W-2s because we have city tax. Grand Rapids, Walker, Muskegon, Muskegon Heights, Lansing, East Lansing, Battle Creek are the ones that come to mind right off the top of my head. I think Benton Harbor started city income taxes a few years ago. So you'll see those occasionally. They do require a different tax form, but we do prepare those right through our tax software. So everything is all in one place. So in our tax software, it's called Profiler. It's proprietary to Jackson Hewitt. This is what our W-2 input screen looks like. So we type in the employer identification number, we type in the wages, box 1, box 2, box 3 and 5, we type that in. 4 and 6 populates for us. If the amounts are not matching what's on the screen to what's on the paper W-2, we can override those figures. Boxes 12, again, we have to enter in all of the codes that are shown on box 12. It gives us 4 spots to do that. And then you can see where the state and local information is as well. All right, let me check and see if there's any questions so far. If I can figure out how to get back to my screen. Candy, I see your message. My link is not working for me to do classes. Can you reach out to us at the tax school email that you got your login and password? That's something Brian or Tom tomorrow, another assistant manager, can assist you with. That's not something I can try and fix during this meeting. Again, if you have any questions, you can raise your hand and I should see that here on my screen. Otherwise, use the online chat and we'd be happy to, or I'd be happy to answer your questions. Doesn't look like there's any at this time, so I'm going to keep going on with the presentation. All right, so how do you handle it if the W-2 your client brings in has the wrong information? Well, it depends on what's wrong with it, and it depends on how we handle it. So if a taxpayer's address is incorrect, and you will see this a lot, we have the ability to correct that on our screen. That is not a reason not to file the tax return. You just want to make sure the tax return has the client's current information, current mailing address, current way to get a hold of them. Our system profiler asks us, is the address on the employee's W-2 match their current address? And if it's no, it will take you to a set of questions so that you can type in the address that's on the W-2 so that they can use it for W-2 matching at the IRS. Now, if the W-2 has an incorrect social security number, doesn't have their correct name on it, or if the employee says that the dollar amounts on the W-2 are not correct, those need to have a corrected W-2 from the employer. They would go and let their employer know about the issue, and the employer would be required by law to issue them a W-2C, so W-2 corrected, and they have to send that to the IRS as well, and to Social Security and the state. And then they bring us back the W-2C so we can enter in the correct information. So again, issues that would require a W-2C are incorrect Social Security number, incorrect name, or incorrect dollar amount. Okay, so sometimes a W-2 is incorrect because it's fraudulent. There are some clues that you could indicate a W-2 is fake. These things are not always indicators that the W-2 is fraudulent. Sometimes it's just a really small mom and pop company that doesn't have a payroll service. They write out their W-2s by hand. Again, everything you do, you look at it, you evaluate it, you ask additional questions to see, does this person seem suspicious, or is it simply a situation where the employer doesn't necessarily have the most up-to-date software or strengths for preparing W-2s. So if a person has duplicate or incorrect copies of the W-2, so again, if they have the Social Security copy, they have the employer copy, that could be an indicator that this is a fake W-2 that they made using software at home. If boxes that should have information are blank, or they look like they've been erased or typed over, again, those are signs of potential fraud. If it's handwritten, typed, or if it's photocopied, I would say, again, just something to ask more questions on, not necessarily fraud, but something to be aware of. W-2s should never have dollar signs, commas, or any symbols. They should just be the amounts, a period, and in the cents. If a W-2 has very high withholding compared to income, so let's say they had $10,000 of income and they had $4,000 of federal income tax withheld, that's very, very unusual and something that needs to, again, you need to ask a lot of additional questions. Why is your federal withholding so high? Did you fill out your W-4 form incorrectly? Just try to get information to see if it seems suspicious or if it's just an honest mistake. You never know. Someone might say, hey, I use the federal government as my savings plan. I like to get a big refund, so I have them take a lot of income tax out of my W-2. Or if it's a married couple and one of the spouses is self-employed and one of the spouses works for an employer, sometimes the working spouse will have more taxes taken out to make up for the other spouse not having any withholding. Okay, due diligence. So as a paid tax preparer, you have to exercise due diligence on every step of preparing a tax return, including W-2s, to make sure that they're not fraudulent. Okay, so military pay. Military pay is handled a little bit differently. Military personnel can receive different types of pay. Taxable income for military members includes their basic pay, any special pay or bonuses they get, and incentives. All of those are required to have federal income taxes. Not all of them have Social Security or Medicare. Our software is really great in that it will walk us through all of this. It's one of those things that when you're new, it's hard to remember everything and no one expects you to. We do expect you to read the screens. We do expect you to pay attention to details, and we expect you to be kind and glad to be there. So we will always be with you every step of the way. So don't feel like you have to have everything here memorized. So allowances. In addition to military pay, the personnel can receive allowances or payments for expenses they incur as a result of their service. Common allowances include living and travel expenses. So when military members move, their moving expenses are generally paid for by the military if it's a required move. When people leave the military, they're often given moving expenses back to wherever they want to end up. You know, so if they were stationed in Texas, but they're from Michigan and they want to come back home, there's oftentimes military moving expenses given to them for that. And those allowances will always be listed on their leave and earnings statement, but they don't show up on the W-2. So the information we have to be concerned about will always show up on the W-2. And that's an example of their leave and earnings statement. Okay, combat pay. So a lot of people don't realize this, but combat pay is not taxable. It's also not included in box 1. Now, a military member can opt to include it in taxable income for the purposes of calculating their earned income credit. Right now, we're not really in any active military operations, so the chances of seeing combat pay on a current year tax return is probably pretty slim. Not going to say it's not going to happen, but I'm just saying I haven't seen one in a lot of years. So here's an example of a military member's W-2. If you look there, he does have combat pay in box 14 for Operation Enduring Freedom. He has a box Q, and of course at this moment I can't remember what the Q stands for. Let me see if I got it in my notes here. Oh, combat pay. So he received $19,473.88 in combat pay. The BAH stands for probably the area he was stationed, because I know that the software will, basic housing allowance, that's what that stands for. That's not taxable to Connor. But again, we would just enter that information in the program and it would walk us right through it. Now, if you look at his box 1, wages, that does not include the amount of his combat pay, but it is included in boxes 3 and 5, his Social Security and Medicare wages. And that's because he's going to get Social Security and Medicare credits for that income. So here you can see where his wages and tips or box 1 information carries to line 1 of the tax return for calculating taxable income. But his basic housing allowance and his combat pay does not. Okay, so occasionally a military spouse will live in a foreign country with the military member. So somebody, you may occasionally have foreign earned income for the spouse that is working in a foreign country. That is a whole different set of rules and procedures that we're not going to cover tonight. It will be covered in a future lesson. Okay, let me check again and see if there's any questions. Nope, doesn't look like there's any questions yet. So I'm going to keep moving on here. Okay, so other employee pay. So in addition to wages, employees can receive tip income. So we talked about that. We're going to go into that in a little bit greater detail here in a few minutes. Prizes, awards, and bonuses, sick and disability pay, and fringe benefits. So tip income must be reported. All tip income has to be reported. Tips can be cash, debit or credit cards, tip splitting. So when everyone throws their tips into a jar and at the end of the night divide them up equally among the employees, that's called tip splitting. And then non-cash items such as tickets or passes. Okay, so Tipped employees are required to keep a tip diary or log. Nowadays, most restaurants have electronic systems in place, and the waitresses and servers or other tipped employees will report their tips every day into the computer system. Um, you know, tips that are paid on a debit or credit card, which a lot of people do now, that's automatically tallied in those systems. They mostly have to report in their cash tips each day. Now, there are still restaurants that are not requiring their employees to report their tips. Those employees really need to keep a tip log. Anytime they have tips greater than $20 in a month, they're required by law to report those to their employers. And the employers will withhold Social Security and Medicare tips, taxes on those tips. I've done payroll for a lot of years for some companies, and restaurant employees, I'm always shocked at how small their paychecks are after their hourly wage, and then they have to pay the taxes on the tips. So really they are working for their tips. That's how they make their money during the week. If their tips are less than $20 a month, they don't have to report it to the employer, but we still have to report it on the tax return. So here's an example of Penny's tip log. And so she and her coworkers worked extra house in January and March, but failed to report their tip income. Her employer allocated tips for these months. So sometimes you'll see that in box 7, Social Security tips. And sometimes you will see box 9, allocated tips, and sometimes you'll see both. All the numbers on the W-2 have to be reported into the tax software and reported on the tax return. So in the months that she received less than $20, she did not have to report those tips to her employer. All right, so box W2 box 1 is $16,855 plus the amount of her allocated tips and her unreported tips from April and July. So her total income on her 1040 would be $18,113. Okay, so everything that we talked about so far, this one is the one that surprises a lot of people. If you win a prize, an award, or you're paid a bonus at work, your employer is required to report that as taxable income. Obviously, when you get a bonus paid in cash or direct deposit to your bank account, you expect that to be reported on your W-2. But what surprises a lot of people is even non-cash awards, they have to report the value of the award on your box 1 W-2. 2 years ago, I had a client who won a fancy tablet from his employer, and he was furious because he thought the value of the tablet was way overstated on his tax return or on his W-2. So that was a big fiasco, and I had to hear all about it. Okay, employees who are sick or disabled may receive sick and disability pay. Now, depending on how that sick or disability pay is paid out, it may appear on their W-2 in box 1. Sometimes they will get a W-2 from the disability insurance company, and sometimes they will receive a 1099-R if they have been declared permanently disabled and they start receiving a sick disability pension. If it's a sick pay W-2, the sick pay box will be marked. And again, we would put that in the program and it would handle that as well. Disability pay. So here's an example of a 1099-R. These are forms that report retirement distributions or pension payments, and they're coded right there as a disability payment, and there's no additional penalty for being under age 59 and a half like there is when a taxpayer takes money out of their 401k early. Okay, so here's an example of an employee's sick pay. It says Victoria broke her leg in a horseback riding accident and she was unable to work. If you look at her W-2 wages prior to her accident, they're reported in boxes 1, 3, and 5. So that's income that she earned when she was still working. Her sick benefits received are non-taxable because the premiums were paid with after-tax dollars. So that right there, code J, is how much she received from that she didn't have to pay taxes on. Now, if your employer allows you to buy disability insurance, but they do it with pre-tax dollars, then those payments become taxable income and they're reported in a different way. And again, you'll see right here, the only number that pulls through to her 1040 is the amount from her box 1 on her W-2, $12,002. Okay, fringe benefits, what are those? So fringe benefits include things like health insurance, child and dependent care assistance, adoption assistance, education assistance, group term life insurance, transportation, parking, and commuting assistance, and other de minimis benefits. Not all of those are taxable though. So health insurance is generally not taxable to the employee, even if the employer pays 100% for that benefit. When an employee does have to pay part of the insurance though, so if your employer pays 1/3 and you pay 2/3 or vice versa, that's done with pre-tax dollars. So that saves you money on your taxes by paying for some of your health insurance. You don't also get to take a deduction for your health insurance premiums on Schedule A though, if you're getting them taken out pre-tax. Okay, child and dependent care assistance. So some employers will help pay for childcare. If they do that, it's reported in box 10 on the W-2, and we use form 2441 to reconcile that on the tax return. If an employee's income reaches a threshold where they don't qualify for that, then those benefits can become taxable. Adoption assistance. So there's a credit for adoption that people can qualify for, but if your employer helps you pay for that, it would be reported in box 12 with the code T. And again, we would reconcile that on form 8839, and they're able to exclude those benefits for income up to the maximum allowance for the year, and only up to, I believe, actual adoption expenses. Don't run into that too much anymore. I've run into it a handful of times over the years. That's also a credit that rolls forward, the adoption credit. So if you don't use it all in 1 year, you can carry it forward to the next year. In some cases, there's different rules depending on if the child was disabled or adopted from foster care or otherwise considered a hard to place child. So educational assistance is a perk a lot of employers or large employers use to attract talent. So they can exclude from your income $5,250 per year that the employee can use for tuition, fees, books, etc. The only time that becomes taxable is if it exceeds your expenses. So if your employer just wrote you a check for $5,250, said do with it what you need to do, but your actual expenses only came in at $5,000, $250 of that then becomes taxable income reported in box 1. Group term life insurance. So again, I mentioned that earlier. Some employers provide life insurance for their employees. And if your salary or your benefit of your life insurance is greater than $50,000, any premiums for that amount above that are reported in box 1 as wages and also in box 12 with a code of C. We don't run into this a lot here in our side of Michigan, West Michigan. This is like states like California, New York, big cities where they have qualified transportation benefits. So people will commute in on the subway or on the high-speed trains, or they have to pay for parking, or they have to pay tolls to get to work. Those benefits can be taxable on a person's tax return. And then de minimis benefits just means that they have a low cost or value that's very difficult for the employer to maintain really good records on. Examples would be discounts at the company store, cab fare that's paid for if your boss asks you to stay late and you miss the last train or bus, when they throw a company picnic, or like at Christmas time where they give you a ham or a turkey or a cheesecake or a fruitcake. Those things are not taxable benefits on your W-2. If your employer gives you a gift of cash or a gift certificate, and I learned this the hard way a long time ago, I worked for a very large employer, My boss gave me $100 gift card for my birthday, and I was just shocked. I couldn't believe it. And then I got my next pay stub, and there it was as a line item on my paycheck. I had to pay taxes on it. I was like, oh, well, thanks. Thanks a lot. Okay, so Chapter 4, Employee Compensation. We learned that wages are the primary source of income for most taxpayers. Employers report their wages, employee wages, and other forms of compensation on Form W-2. And the Form W-2 includes information on the wages, tips, income tax withholding, and Social Security and Medicare taxes. An employee's compensation can also include bonuses, prizes, and tips. And all compensation is reported in box 1. If a taxpayer's address is incorrect, that does not stop us from filing a tax return. If their name, social security number, or the dollar amount is incorrect, we need to get a corrected Form W-2C. Military personnel have special tax benefits for being armed forces members. Combat pay is not taxable income. It will not be reported in box 1. All tips are subject to federal and state of Michigan income taxes. Employees are required to keep tip logs, and anytime they make less than $20 in tips in a month, they're not required to report it to their employer, though they still certainly can, but they do have to report tips on their tax return. When a taxpayer receives sick benefits, they're taxable income. Box 2, Code J, indicates individual received non-taxable sick pay. An employee received disability income before retirement age, they may get their income reported as a W-2 or possibly a sick pay pension. All right, so let me get out of this one and switch over. I'm going to check and see if you guys have any questions first, because I know that was pretty quick. Don't see any questions yet, so let me get the next one started.
I have a quick question for you.
Okay.
This is the first one I've joined. Is there someone I can reach out to? Because I didn't get to go to 1, 2, or 3, and I haven't heard anything else. This is the first email I've received about this class.
I can resend that training video. I sent it out on Monday. So did you register since then?
I haven't even gotten anything about registering. I've only put my info in. No one's reached out to me. Nobody's talked to me. I don't have anything besides this.
Okay, check the email address. So what kind of email did you use? Was it Gmail?
Yes.
Okay, so Gmail likes to send our emails to your spam folder or junk mail. You know how they have the different tabs in Google?
Yeah.
Check your email. So do a search in your Gmail for an email from Tax School at MIJH Tax Pro, and that is where you'll find your login and password.
Okay.
And then on Monday, I had sent out a text message to everyone that was registered in Tax School as of Monday with the recording from last week. But if you can send me an email to that Tax School email address, I can send you a copy of the link to that YouTube video that's last week's recording.
Okay, perfect. Thank you.
You're welcome. Thank you so much. All right, let's see if I can figure out how to share my other screen. Again, I'm not always the most techie person, so I'm trying to learn, but I do know taxes, and that's what counts. All right, so the Savers credit and the child tax credit. I was very surprised they actually combined these two into one lesson because child tax credit can be very complicated. And the child tax credit for 2021 was completely different than all the other years of the child tax credit. As part of one of the coronavirus packages, relief packages, they made a whole bunch of changes to it for last year that were a 1 year and done kind of situation. So if you guys don't see Chapter 5, Savers Credit, one of you unmute yourself and tell me, but you should be seeing that on your screen. Okay, so this chapter, Chapter 5, by the end of the presentation, you should be able to determine who qualifies for a retirement savers credit, what it is, and how you report it, the child tax credit, and the credit for other dependents, and what to do if a taxpayer was denied the credits, what to do the next year after that. Okay, the savers credit is a wonderful credit. The purpose of it was to incentivize. It was to convince people to participate in their retirement savings programs at their jobs. The Savers Credit is non-refundable. It's up to $1,000 for a single person or up to $2,000 for a married filing joint. Non-refundable credits mean it can be used to reduce taxes due or the total tax amount on the tax return, but it cannot be given to you as a refund. So we'll talk a lot about refundable versus non-refundable credits later, later in tax school. But for now, all you need to know is that means you cannot get it as a refund. So if you have zero tax liability, but you participated in your work's 401k program and your income was in the right threshold, you can't get it. You have to have a tax liability. So the credit is received again for making eligible contributions to an employer-sponsored retirement plan or to an IRA, an individual retirement arrangement. IRAs are done outside of work. So if you work for an employer that doesn't offer a 401k or they don't offer a 401(b), I think it is, whatever nonprofits use, I can't remember the little code section, people who can still participate in retirement savings and still qualify for this if they're doing it individually with an investment advisor. And the Savers Credit is reported on Form 8880, Credit for Qualified Retirement Savings Contributions. Okay, so this is where I always thought was kind of crazy. Some of these, who qualifies, who doesn't qualify. It makes sense that it's limited by income. That depends on filing status. What I never thought was right is if the following is true, the individual cannot qualify for the credit. If they were under age 18 at the end of the tax year. So let's say we had a young person who graduated at 17 and they were already participating in their work 401k plan at work, or they worked full-time during the summer and they qualified. Doesn't matter. You don't qualify for it if you're under 18. If you're claimed as a dependent on someone else's tax return, you cannot get this credit, even if you're saving for retirement already. And if you are a full-time college student working full-time and participating in 401k, you do not qualify for this credit. And I always thought that was absolutely ridiculous. If you're going to college and you're working your butt off and already saving for retirement, you should be compensated and rewarded for that. But again, they didn't ask my opinion. Sorry you guys had to hear about it. Okay, so eligible contributions are made to traditional or Roth IRAs, ABLE accounts, and they're done through salary reduction contributions to the employer-sponsored retirement plans. Certain voluntary after-tax contributions are also eligible. So what triggers this credit in the tax software is if box 12 has a code D, E, F, G, H, S, double A, double B, or double E. Let's see. Okay, so how do we calculate and claim the credit? Again, Form 8880 is used to calculate the credit. If there's a credit amount on the Form 8880, it gets carried to Schedule 3, and then it is carried into the Form 1040. So here, let me show you. Here's an example for Winnie. Her W-2 shows she had income. She didn't have any distributions from her retirement account for this year, and she had contributions to her 401k of $753.09. You can see there down in box 11, Winnie's adjusted gross income is $24,350. Box C. All right, so line 2 on Form 8880 is where her retirement contributions go in. And then line 6, in this column, enter the smaller of line 5 or $2,000. So the maximum that they allow you to base your contribution on or your credit on is $2,000 of contributions. So if you put $4,500 into your 401k, that line, it's only going to be based on $2,000. Then you look at her AGI down here in the chart. She was at 24,350. So you can see there that if she's single, her credit is going to be 0.1. It's going to be the multiplier. So for her, her credit is going to be the lesser of line 10 or line 11. So line 10, which was $753 times the 0.1 is $75. Her limitation based on her tax liability. So if you looked at the second page of her 1040 where it said tax liability, that was $1,220. So she gets a smaller of that. So her credit is $75, which $75 is $75. We'll take it all day long. Here it is in a little bit bigger format, showing you where all the numbers carry to. And then here's how it carries to the tax form. So Schedule 3, Part 1, non-refundable credits, line 4, and then that line 4 is going to carry to Form 1040, line 20. Now, again, if there's other credits that they qualify for on Schedule 3, these are all going to add up together and carry to line 20 on the Form 1040. And thankfully, the software does this for us, but you still need to learn how to read the Form 1040 and understand what the values of the numbers mean so you can explain it to clients. But again, that's something we work through and practice and teach on, so you'll get really good at it. All right, so here's some screenshots from our tax software profiler. It will ask questions if they made any additional deferrals outside of their work. Most people don't, some people do, so you ask everyone. Tax software will also carry forward all of the information from box 12. Now, if they're a new client this year, we don't know, the system won't know automatically if they had any distributions in prior tax years. So we would have to ask them those questions. Let me see. All right, so it says the following identify distribution amounts from Form 880 line 4. Winnie has never received any distribution, so all of her answers would be 0. All right, here's a demonstration from our tax software profiler.
For this demonstration, we will be covering illustration 1, which is Winnie Folgeman's tax return. In this illustration, Mr. Folgeman is looking to claim his retirement savers credit. And referring back to what you've learned in this chapter, you know that for a taxpayer to become eligible for the savers credit, they must, number 1, be 18 years or older, number 2, not claimed as a dependent, and number 3, they're not a student. The purpose of the credit is to incentivize those with modest incomes to save for retirement by offering a non-refundable credit for retirement contributions. Looking at Mr. Winnie Folgeman's tax return, we see his earned income is $24,350. This is taken from his W-2 income. And his taxable income is $11,950, shown on the bottom of page 1 of his Form 1040. This tells us that because Mr. Folgeman has taxable income, he is potentially eligible for the savers credit. As we pull up Mr. Folgeman's completed Form 8880, we see his retirement savings credit was claimed. To start, his elective deferrals made to his employer contribution plan, which is the amount on box 12 code B on 72, is reported on line 2 of the Form 8880. If Mr. Folgeman contributed to an IRA, the amount contributed would have been reported on line 1. The net of these two amounts is then added on line 3. The line 3 amount is then subtracted by any distributions made during the year, which in this case does not apply. Then on line 6, the total amount reported becomes the lesser of the net we just calculated, which in this case is $753, or $2,000. In this case, we enter $753, which flows to line 7. Then on line 8, we report the amount of total income shown on Form 1040, line 11. The amount listed here will determine the percentage of the credit shown in the chart below. Looking at the chart, we see Mr. Folgeman's income lines up on the income row, shown between $21,250 and $29,250. And looking under the single column, we see his appropriate percentage of the credit is 10%, which is then reported on line 8. Line 10 will multiply the amounts of line 7 and line 9, giving us the total potential savers credit of $75. This amount is then compared on the credit limit worksheet to verify that his savers credit does not exceed the total tax paid. Again, because the savers credit is a non-refundable credit. Because this credit is below the tax amount, he receives his full eligible savers credit, which is reported on line 12, and then it's finally carried to Schedule 3, which ultimately ends on Form 1040, line 20. Now that we have seen how the final form is supposed to look, let's see how those entries may appear on a tax software. We start halfway through the tax. For this time.
All right, sorry about that, guys. I didn't realize he was going to say everything I said. But at least you know now that I had my information correct. So let me check and see if you guys have any questions about the savers credit. It doesn't look like it. I don't see any hands raised and I don't see any no comments. So I'm going to move on to the child tax credit. All right, so I do want to preface this with this information for the child tax credit. It is based off tax year 2021. That is one limitation of tax school is a lot of the current like 2022 tax information is still in process, especially in an election year. Well, every year is an election year, but every year after the election, they have this thing called a lame duck session. And sometimes outgoing senators and members of Congress will pass laws or extend laws, just depending on who's in power. So it's very hard to predict what the next tax year is going to be like. So tax school is kind of always a year behind on totals and values and things like this. But this is good because you are probably going to have clients come in who need to file a 2021 tax return. So it's good to know about these changes. So I just want to preface that for you and make sure you guys know, memorize the totals to take the test, but just know that like the standard deduction amounts you're going to learn, the child tax credit amounts, the income level amounts, all of those things are going to be a little bit higher for 2022 tax year just because of inflation adjustments. Okay, so let's go ahead and get started. So the child tax credit had two parts most years, but for 2021, it was a refundable child tax credit, and it's only for taxpayers who had qualifying children. This is calculated on Form 8812, and it says here, in addition to the RCTC, refundable child tax credit, there's a non-refundable child tax credit and an associated refundable additional child tax credit that may apply for taxpayers who do not qualify for the refundable child tax credit because they don't meet certain residency requirements. Them are all new terms for me because that's not what we used to call it. So we're just going to proceed. So in order to qualify for the refundable child tax credit, again, this was for 2021, they had to have a taxpayer identification number. They had to meet the residency requirements, had to have a qualifying child, and they had to have credit, they had to have income limits. So a taxpayer identification number, this most typically for most people is a social security number. If it's a person who is not a US citizen, they do not get a social security number. They only can get an individual taxpayer identification number. We call it ITIN. This is used only for creation of tax returns and tax reporting. It is not, doesn't guarantee them any other benefits. It doesn't give them social security benefits. It's again, only for filing tax returns. They have to have their social security number or their ITIN by the due date of their tax return, or they do not qualify for the credit. So they can't file a 2021 return in 2022 tax year, so 2023, and still get these credits if they did not already have a social security number or ITIN back before the original return was due. Okay, residency requirements. To claim the credit, the taxpayer or the spouse, if filing jointly, must meet at least one of the following requirements. They had to have their main home in the United States for more than half of the year. but it does not need to be a permanent residence or a permanent address. And they have to be a resident of Puerto Rico or be a resident of Puerto Rico. Qualification though, if it's a military member and stationed outside the United States, they are still considered to have lived in the United States if they are there for their job. Okay, who is a qualifying child for the refundable child tax credit? A qualifying child must be claimed as a dependent on the taxpayer's tax return. They must have a social security number. They had to be under age 18 during the tax year. And they could not provide more than half of their support, of their own support. They had to live with the taxpayer for more than half the year. Exception would be temporary absences, like going to stay with their other parent, going to camp, or if they went to a school where they lived on campus, or if they were on vacation. The qualifying child has to be a citizen, resident, or a national of the United States. They cannot file a joint return for the year, or if they do file a joint return, it can only be to claim a refund. Example of that is your 17-year-old child gets married to their high school sweetheart, and you still supported them all year. They can file a joint return with their spouse just to get a refund of taxes withheld, and you can still claim that young person as a dependent on your tax return. That's the only time that's what the joint return test means. And they must be related to the taxpayer in an appropriate way. Appropriate relationships would include son or daughter, including adopted children, stepson, stepdaughter, foster child, brother, sister, stepbrother or stepsister, half brother, half sister, or any descendants of any of these individuals, such as grandchildren, nephews, or nieces. Children who are born during the year are considered to have been alive for the entire year, and same with children who have passed away. Considered to have been with you for the entire year. The 6-month rule does not matter. So here's some examples. Nathan and Olivia are not married. Their daughter Patty lived with Olivia for the whole year. So Olivia completed Form 8332, release of claim to exemption for the child of the custodial parent. So this is what divorced families use, or unmarried couples who are no longer together but share a biological child. The default person who gets to claim the child as a dependent is the custodial parent, the one who the child spent the most time with. A lot of divorce decrees will say taxpayer claims child every other year. The IRS doesn't have to follow divorce decrees. Technically, the IRS is going to say, if you're not the custodial parent must complete Form 8332 and release the claim for that child for this tax year in order for the child to be claimed by the non-custodial parent. And we are seeing more and more where the IRS is rejecting child tax credit payments to non-custodial parents for not turning in that form. Matter of fact, if you don't turn in the form, you're definitely not going to get the child tax credit. So in this case, whose qualifying child is Patty? It says Patty is not Olivia's qualifying child because she released the claim to Patty's father, Nathan. And Patty is Nathan's qualifying child under the special rules for divorced or separated parents. So that is the only time that a child does not have to live with you for 6 months, and you still can get the child tax credit. All right, example 2, Xandra is single. Her son Malcolm 8 is not a citizen of the United States, but he lived in Mexico all year. Xandra does qualify to claim Malcolm as her dependent, but is he a qualifying child for the refundable child tax credit? No, Malcolm is not Xandra's qualifying child because he is not a United States citizen, resident, or national. So again, do I expect you to remember every single detail of who qualifies for these credits? Absolutely not. Do you need to have a general idea? Yes. Our software will always walk you through it. You just have to be able to answer the questions accurately and understand what the questions mean and it will never steer you wrong. I'm not sure I'm sure you guys know by now, a lot of our locations are inside Walmarts. And when you work inside a Walmart, you get a lot of random questions throughout the day. And I gave up trying to memorize every single detail, every single credit amount a long time ago, because like I said, they change every year. IRS has a lot of great tools on their website. They're called interactive tax assistants, and you answer the questions and it gives you the answer. Because you are going to get people come up to you and say, hey, I heard I can claim my brother's daughter's boyfriend's child because I supported them all year. And people don't want to hear you say, that's not true. So if you have time, I always say, why don't you have a seat? Let's go through the questionnaire on the IRS website and find out exactly what the IRS says about your situation. And that way they believe you. You've just gotten credibility. So again, don't feel like you have to memorize everything. You need to understand the concept and the basic details, but we have lots of tools available right at our fingertips to get the correct answer to our clients or potential clients. You always want to be the tax expert if you're working in a Walmart. Okay, so calculating and claiming a refundable child tax credit. So the step one, you have to enter the name and identifying number, so Social Security number or ITIN, in the dependent section of the 1040. This is on page 1, right underneath the taxpayer's personal information is where all the children's information goes. You'll mark the box if they're qualified for the child tax credit. You'll use Schedule 8812 to calculate the credit. And then if they qualify, that value will carry over to Form 1040. And anybody who qualifies for a refundable child tax credit or an earned income credit, there was a tax code change or a law passed called the PATH Act. I can't remember what year it was passed. I think 2017 maybe, or maybe a little sooner than that. Any refundable credits can't be refunded prior to February the 15th of the calendar year. What we're seeing in practice, though, is a lot of people who get these credits, their refunds aren't coming until the later part of February, so closer to the 28th or early March. And these people tend to be very impatient. They want their money yesterday. So these people are the type, some of them will call you every day after February the 15th asking you, where's my refund? Where's my refund? Where's my refund? Of course, we take our time and we tell them the same thing, when we expect to see it. Okay, so again, these are 2021 tax values. So the 2021 tax return. The maximum refundable child tax credit that they could receive was $3,600 per child under age 6. The maximum they could get per child for ages 6 to 17 was $3,000. 2022, the child tax credit reverts back to pre-pandemic levels. It's $2,000 children birth through age 16. Once a child reaches age 17, they no longer qualify for the child tax credit. I always thought that was kind of funny because in my opinion, when they hit 17, that's when they eat more and they cost more and they're no longer worth $2,000 on your taxes. Come on. These people didn't raise teenagers, at least not teenage boys. All right, so the refundable child tax credit amount over $2,000 per child, so the $1,000 or the $1,600 begins to be reduced to $2,000 per child if the taxpayer's modified adjusted gross income is greater than $75,000 for single or married filing separate, $112,500 for head of household, or $150,000 for married filing joint or qualified widowers. So what does that mean in layman's terms? That means once your income exceeds those levels, your child tax credit goes down. And once your adjusted gross income is greater than $400,000 for married couples or $200,000 for all the other filing statuses, you no longer qualify for the child tax credit. Okay, so part 2 of the refundable child tax credit. We already talked about that. If their modified adjusted gross income is too high to qualify for part 1, they may qualify for a maximum of $2,000 per child. The child must be under age 18. Again, in 2022, that's 17. And the refundable child tax credit is reduced below the $2,000 if their income exceeds the $400,000 or the $200,000. What is a modified adjusted gross income? It's not the same as adjusted gross income. They add some things back to it to calculate that. Advanced child tax credit payments. So again, in 2021, it's part of one of the coronavirus pandemic relief laws that they passed. People received $500 per child in advance. I think it was 500. Maybe it was 250 or 300. I misspoke. Depending on the age of the child, they got $250 or $300 per month in advance starting in July of 2021 through December of 2021. We had to reconcile those on the 2021 tax returns. People received letter 6419 letting them know how much they received in advance, and each member of the filing family, the taxpayer and the spouse, would receive their own letters for half the amount total. Most of these payments were made by direct deposit. Some of them were made by paper check. Sometimes people got one or the other. Sometimes they got both. It was a very interesting time in the tax world. So if this is advanced child tax credit payments, if the amount of the taxpayer's maximum refundable child tax credit is greater than the total amount of the advance payments, they could claim the rest of the credit on their tax return. However, if the payments that they got were less, they may have to repay it. There was a safe harbor, so if people were below a certain income, they did not have to repay those advanced child tax credits if they didn't qualify for them or if their income was too high. I'm sorry, the income too high thing I just transposed. People who got the payments that weren't supposed to, or they got more than they were supposed to, if their income was below a certain threshold, they did not have to pay that back. We saw a lot of this for unmarried couples who take turns claiming their children, or divorced couples who take turns claiming children. They were supposed to report, hey, I'm not claiming this child for the tax year. Please don't give me this money in advance. But as you know, in the real world, that wasn't really talked about in the media, and the information didn't get out there, or people just didn't want to do it. So a lot of people never reported that, and a lot of people got payments that they weren't entitled to, and a majority of them didn't have to pay it back. And the ones who did have to pay it back were very unhappy, very, very unhappy. So here's an example. Andy claimed his 3 qualifying children on his prior year tax return because those payments were calculated on 2019 or 2020 tax returns dependents. So if I had claimed my children, my 12-year-old son, on my 2020 tax return, I got $250 per month in 2021 based off of who I claimed on my 2020 tax return. So if he doesn't claim those children, or he's only claiming one child on his 2021 tax return, he may have to pay back the extra money he received above the amount that he was qualified to get for the one child. Again, depending on where his income fell for the year. Here's another example of how this works. Angelo is finally had a household. He has 2 dependents, a 10-year-old and a 3-year-old. Both children qualified for refundable tax credit, and his modified adjusted gross income is $67,100. As you can see, his modified adjusted gross income matches his adjusted gross income. There was nothing that needed to be changed on his. So here's a copy. This is what the letter looked like that people received. Showed that his credit and advance payments were based on 2 children. Here it is a little bit bigger, so you can see it a little better. Here's the safe harbor thresholds. If you look and see where it says repayment protection right here. If you were married and filed a joint return, If your income exceeded $60,000, you may have to pay the advance credits back if you didn't qualify for them. $50,000 for head of household and $40,000 for single or married filing separate taxpayers. All right, so this is how it carries to the tax return. Let's see if this is automated. Nope. Okay, so his adjusted gross income carries to the calculation form. He had 2 qualifying children, one under age 6 and one over age 6. So those were different amounts of credits. $3,000 for the 10-year-old and $3,600 for the 3-year-old. So his total child tax credit for 2021 was $6,600. He got $3,300 of that in advance based off his letter and based off of what he told us. Yep, he got $550 per month for 6 months. We put that on there and he still owed the other half because again, they only got half of it in advance. So he gets a $3,300 credit on his taxes. And this is a refundable credit, meaning he gets it back even if he did not have any tax liability. Okay, so this is a screenshot from our tax software, kind of showing how the dependent information looks after you have entered it all in there. It's got their birth dates, their names, type of dependent, son, daughter, did they live with you, how many months, did they support themselves, and can somebody else claim this child as a qualifying child? Our software also tells us about the types of credits that they qualify for. In this case, both of these children qualified for child tax credit and not for the other dependents credit that we are going to talk about here in just a few minutes. All right, and again, I'm not going to go through all of these. These are just questions from our profiler software. Once you start working with us, you will get lots of practice on profiler. Not going to do the demonstration for you. Let me skip this. Okay, let me check and see if there's any questions, and then we'll get into the other dependents credit. Nope, doesn't look like there's any questions, but if you have any, you can, again, send them to me through chat, or you can unmute yourself and just ask away. Otherwise, I'm going to continue on with the presentation. Okay, the other dependents credit. All right, so this came into place with the Tax Cuts and Job Act of, I think it was 2017. So it went into effect for tax year 2018. Remember how I said that once a child hits age 17, they no longer qualify for the $2,000 child tax credit. Again, $2,000 is the normal amount, is what it's going to be for 2022 for children 16 and younger. That's when they came out with this other dependents credit. So if you are claiming your teenage child or your college student, or you're claiming your disabled adult child, or you're claiming your parents on your tax return because you're taking care of them in retirement, they qualify as an other dependent credit. Unfortunately, the credit's only worth $500 and it's not refundable, meaning it only can be used to reduce taxes. You cannot get it as a refund. It is also calculated on Schedule 8812, and it still has the same requirements for taxpayer identification numbers and income limits. So again, to be other dependent, they have to have a tax number, they have to qualify, and the residency requirements are different. That's the one difference. So in this case, remember how earlier the person couldn't claim their son because he was a Mexican, or he was a citizen of Mexico? In this case, that child would be an other dependent. So she would get $500 for him instead of the $3,000 she would have gotten if he was a US citizen. For the other dependents credit, they still have to be claimed as a dependent on your tax return. They cannot be used for the refundable child tax credit. So you can't get both, it's one or the other. And they do have to be a citizen, resident or national. Example, Mary Beth is single. She's a Canadian citizen. She has a taxpayer identification number and she lived in the US all year. She provided support for her children, Marissa and Jake, 14 and 15, also Canadian citizens who have ITINs but do not have income, and they lived in Canada with Mary Beth's mother all year. Are Melissa and Jake Mary Beth's dependents? Yes, they are their dependents because they meet the general citizen or resident test to be dependents because they're a resident of Canada. But they're not qualifying children because they did not meet the qualifying child residency test. However, they meet the test to be qualifying relatives. So we talked about that in last week in chapters 1, 2, and 3 about the difference between a qualifying child and a qualifying relative. I don't want to get into it tonight because there's a lot of differences between the two. Just make sure when you do tax school, you pay attention to those details. And again, in practice, our software, you're going to answer the questions and it's going to determine if they're a qualifying child or qualifying relative based on the answers to the questions. And qualifying relative isn't really a relative. Like they don't have to be related to be a qualifying relative. Sometimes in the tax world, terms are a little different. So relative doesn't mean related, just means they qualify. Are Marissa and Jake Mary Beth's qualifying children for the refundable child tax credit? Also, no, they don't have Social Security numbers. They didn't live with her for more than half the year. They're not U.S. citizens, residents, or nationals. Are Marissa and Jake her qualifying individuals for the other dependent credit? No, because they're not U.S. citizens. So I misspoke myself earlier when I said that the little boy who lived in Mexico could be claimed as the other dependent credit. I messed that up. He would have to be a U.S. citizen, resident, or national. Okay, suppose all the facts are the same as in the previous example, except Marissa and Jake are U.S. citizens with Social Security numbers. Then they become dependents. They don't qualify for the refundable tax credit though, because they did not live with her for half the year. But they do meet the qualifications to be an other dependent because they are U.S. citizens. So how do you claim and calculate the other dependents credit? It's same thing. You put them in the dependents section of Form 1040. You mark the credit for other dependents box. Again, software is going to do this for you. Schedule 8812 is used to calculate the credit, and any amount that is calculated will be carried to Schedule 3 and then on to the tax form. All right, so these are just examples. Don't need to go through that. So this is, again, the form for calculating the refundable child tax credit and the other dependents credit. And a lot of these screens you're seeing are going to be the same as what you see when you take the tax school module online. So don't worry that I'm hurrying through this. Okay, and I'm not going to do this demonstration of our software. But this is someone who has a lot of dependents. So that's what this is kind of showing, is how it looks when you have multiple dependents on the screen. You see how some of them qualify for have different answers. We got a parent, daughter, a son, nephew, no relationship. That's a question you'll get asked at Walmart a lot if you're working in a Walmart, is can I claim my neighbor's son, or can I claim my boyfriend or girlfriend's child? And then we've also got a grandchild on here.
Illustration 3. Bernadette E. McClearly.
Okay, so real quick, credits, claiming these credits after they're disallowed. So sometimes people claim credits they're not entitled to. And when the IRS catches them, they will send them a letter saying, you can't claim this credit anymore because you claimed it incorrectly in the past. There is a workaround for that. If it was not done intentionally, the person wasn't trying to get credits for kids they weren't supposed to, if it's usually a mathematical or clerical error, you can fill out Form 8862, information to claim certain credits after disallowance, to claim it on the next tax year. Now, we always ask people have you ever received a letter from the IRS stating you cannot claim this credit? And they always say, no, I've never gotten any letters from the IRS for anything. And then the tax return gets rejected and said, you did not file this with Form 8862, information to claim certain tax credits after disallowance. So the IRS is on it. And usually then we ask them then, are you sure you never got a letter? They still say no. We can put it through for clerical error. Clerical error might be they forgot a W-2, so their income wasn't reported correctly. We see this a lot for earned income credit being denied because they didn't report their income correctly. But it's the same form gets filled out for child tax credits and for the earned income credit if it's the system's trying to tell us they don't qualify. So here's a copy of like a CP 79 notice. That's how the IRS lets you know that you claimed a credit you weren't supposed to claim. Now, if somebody gets this letter and they're like, no, I really was supposed to, there's usually an appeal process. And this is what we spend a lot of our summer working on is IRS notices, working to resolve them for our clients. Okay, so when is Form 8862 not required? It says if the taxpayer's child tax credit was denied or reduced in an earlier year and both of the following are true, the taxpayer filed Form 8862 and then their credit was then allowed, or the taxpayer's child tax credit has not been denied or reduced again for any reason other than a math or clerical error. So at that time, then they can file child tax credit without having to file that form. If the child tax credit was denied for an error due to reckless or intentional disregard, they cannot claim the child tax credit for the next 2 tax years. And if it was due to fraud, they can't claim it for the next 10 years. And those people definitely should not be filing Form 8862. They should not be claiming those credits because they are not entitled to them. Here's another example. We don't really need to worry about that. It's just another illustration, just another example. All right, so let's just go over the recap. Let me check and see if there was any questions about the other dependents credit. Doesn't look like it. So let me go ahead and get back to my presentation. All right, so the things we covered in Chapter 5, Savers Credit and Child Tax Credits. The Retirement Savings Contribution Credit, again, is a non-refundable credit for people who contribute money to their traditional or Roth IRAs, their 401k plans, or any other qualified retirement plan. The amount of the Savers credit is based on taxpayers' filing status, their adjusted gross income, and their contributions. Form 8880 is used to calculate the credit. The refundable child tax credit is for taxpayers with qualifying children who meet all of the requirements, including being claimed as a dependent and having a Social Security number before the due date of the tax return, including extensions. We use Form 8812 to calculate the credit for qualifying children and other dependents. If the taxpayer dependent is not a qualifying child for the refundable child tax credit, they may be a qualifying child for the non-refundable child for other dependents credit. Again, both of those credits use Form 8812 to be calculated. And if their tax credit was ever reduced or denied because of a mathematical or clerical error, they may receive a notice from the IRS stating they have to file Form 8862, information to claim certain credits after disallowance on future tax returns. Okay, so here it is, a summary of changes for tax year 2022. So the refundable child tax credit has been eliminated. So in all years but 2021, the child tax credit had 2 terms. There was the child tax credit and then the additional child tax credit. And that's how it's reverting to. So let me just continue to go on with the slide. The child tax credit is non-refundable up to $2,000, meaning the most you can get for your child is $2,000 if you have a tax liability. So if your tax liability on your tax return is only $1,500, you can only get $1,500 for a child tax credit. Now, if you have other non-refundable credits, they all kind of come in together. So if you had a Savers credit for $250 and a child tax credit, the 2,000, but you only had $1,500 of liability, that's all you get. The qualifying child age requirements are reverting back to the old credit amounts. So again, if they're under age 17, so 16 and younger, qualify for the $2,000. The child tax credit amount is reduced once your modified adjusted gross income exceeds 400,000 or greater than 200,000 for all other filing statuses. Now, this is what's different. In 2021, the entire child tax credit you could get back as a refund. So you could get 3,000 or 3,600 depending on the age of the child, 17 and younger. 2022 goes back to the maximum credits 2,000. Again, you can only get the full $2,000 if you have tax liability. But there's a second part to the child tax credit. It's called the additional child tax credit. It's refundable up to $1,400, which is not right because it used to be $1,400. This year it's going to be $1,500. And that's a new change because it was never $1,500 before and it was never adjusted. It had been $1,400 for many, many years, was the most a person could get as a refundable credit. But it was based on income as well. So someone who had very low income was not getting $1,400 back as a refund on their taxes. They may have only gotten $250 or $300 or $500. Again, it was all based on where their income fell. So that's it for tonight. Again, if you have any questions, feel free to ask. I'm here, happy to help. You can always send me an email to the tax school email. I'm not back in the office until Monday. I've got some other tasks I need to complete this week where I won't be in the office. So if you have any questions, let me know. Same thing when you're taking the modules online. Always let us know if you have questions. We're happy to help, happy to try and help you. If you're having login issues, reach out to us. You can call us at the office or you can send us an email. There's 3 of us who monitor that email depending on who's working. So we'll usually try to get back to you within 24 hours on a business day. So thanks again for joining me today, and I look forward to seeing you guys next week. I don't have my list with me to see what chapters or topics we're covering, but I'm sure it's going to be interesting and fun. And thanks so much again for joining tonight. Have a good night.